In today's episode, we'll talk about two interesting stories. In the first one, we'll talk about how the last quarter went for Eternal and Swiggy. And in the second one, we'll again cover the quarterly results, but this time for Midcap IT companies. Hello and welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and bring you the biggest news in the financial markets in a way that's one level deeper as compared to other news channels. I'm your host, Kashish Kapoor. Today is Tuesday, May 12th. Eternal just crossed a milestone. For the first time since its acquisition, its quick commerce arm, Blinkit, had more monthly transacting users than Zomato. Last quarter, 2.72 crore different users used Blinkit every month, against Zomato's 2.54 crore people. Meanwhile, over at the arch-rival Swiggy, the same quarter showed the opposite tilt. Its food delivery arm posted its strongest growth in nearly 4 years, while quick commerce slowed. In fact, its dark store network grew by just 7 stores against Blinkit's 216. India's two listed giants in the hyper-local commerce, it appears, are beginning to move in opposite directions. And yet, interestingly, both posted what amounted to one of their best quarters in years. What we're seeing, perhaps, are the first signs of an industry filled with hyper-growth startups finally settling into a shape. Both companies posted rather strong numbers last quarter. Eternal's numbers, in fact, looked exaggerately good. It reported a revenue of nearly 17,300 crores, which was almost 200% higher than its revenue from the same quarter last year. Similarly, its net profit at 174 crores was nearly 4.5 times what it had earned a year ago. Now, these are incredible numbers, but they come with caveats. That wild revenue jump is largely an accounting artifact. In the first quarter last year, Blinkit went from a marketplace model, that is, it sold goods for third parties and only booked commissions, to an inventory-led model where it owns the stock and books the full value on every sale. Even once you strip that out though, its like-for-like revenue grew at still incredible 64%. Swiggy had an exceptional quarter too, though not as stellar as Eternal's. Its revenue came to around 6,383 crores, up 45% year-on-year. The company is still making losses, but its net loss for the quarter narrowed substantially to 800 crores from nearly 1,100 crores this time last year. For both companies, this was a strong end to a year otherwise marked by heavy expenditure. Despite its strong showing in the March quarter, for instance, Eternal's full-year profit declined by about 30% year-on-year, bearing the weight of heavier depreciation and finance costs. Similarly, across the full year, Swiggy's losses widened by about a third, given how it spent most of the year carrying out heavy investments in Instamart. You see, something's changing with the food delivery business. These arms of both companies no longer behave like explosive, volatile startups. Instead, they seem quiet and perhaps even predictable. Zomato's food delivery for the quarter grew 18.8% year-on-year, measured by the net order value, to a great extent because it had 1/5 more users over last year. This was the company's third consecutive quarter of acceleration after its growth bottomed at a little over 13% last June. Its margins, meanwhile, held at a healthy 5.5% of its net order value. At Swiggy, food delivery grew 22.6%, measured by gross order value, a slightly different metric from Zomato. That's the fastest it has grown in 15 straight quarters. Like Zomato, Swiggy too had over 1/5 more users than last year. Meanwhile, its profitability went up too. Its EBITDA margins rose to 3.3% of gross order value, which is a lifetime high. Frankly, the two businesses are starting to look rather similar. They're growing revenues somewhere between late teens to early 20s. Both are onboarding new users at roughly the same pace. Both guide 5 to 6% EBITDA margins in the medium term. They're both growing businesses, but they're no longer startups that defined a generation. Instead, it appears they're slowly turning into boring cash cows. If there's one difference though, it's what they're building around that core business. Over recent quarters, Swiggy has launched a series of specialized propositions inside its food delivery app. Bolt, which offers 10-minute deliveries from restaurants near each customer, now makes up over a tenth of Swiggy's food delivery volumes. It has other less-known propositions, from 99 Store for budget-conscious customers to Food on Train, which gets food to your train journey. Put together, all these initiatives make up a quarter of Swiggy's food business. Now, of course, many of these experiments went nowhere. This quarter, for instance, Swiggy shut down Snack, its micro kitchen experiment. The category, according to its management, just didn't seem big enough for how complex it was to pull it off. Eternal is more conservative. In fact, it sounds skeptical of the direction that Swiggy is taking. When asked whether the company would replicate Swiggy's Toing, a new marketplace for affordable restaurant, the CFO flatly refused, claiming he simply couldn't see what the problem Toing was solving. This is beginning to look almost like a difference of strategy. One company experiments extensively and prunes out whatever isn't working. The other waits for clarity before making any changes. The outcomes seem similar. Both run food delivery businesses that grow at similar rates and earn similar margins. The path to getting there, however, looks very different. Quick commerce, however, is where the companies diverge. Both companies rapidly grew their quick commerce offerings. Blinkit's net order value rose by more than 95% year-on-year from last quarter to roughly 14,400 crores. Instamart's gross order value grew rapidly as well by over 60%, but its total quick commerce business is just a third that of Blinkit at under 5,700 crores. Blinkit also hit its first profitable quarter based on its adjusted EBITDA, making a small profit of 37 crores. Instamart in the same period bled 858 crores. Blinkit is growing much faster too. It added 216 net new dark stores this quarter to an overall tally of 2,243. Instamart has just half as many stores at 1,143 and it could only add 7 last quarter. But curiously, each order on Instamart seems to yield much more revenue than Blinkit. Its average order value was 700 rupees. Blinkit's was much lower at 525 rupees. These no longer look like the same business. And this isn't entirely by accident. As Swiggy's CEO noted in his shareholder letter, quick delivery has become a commoditized market. Every player now has 2 choices to get ahead: differentiate or offer better value. Swiggy decided on differentiation. As he put it, India's 3 quick commerce giants, that's Blinkit, Swiggy and Zepto, are making 3 distinct choices. One player, likely Blinkit, is operating at around 4 to 5% contribution margin. It has arguably become the industry's incumbent with both scale and density and an inventory-led model that lets it manage margins directly. Swiggy is approaching break-even. A final one, perhaps Zepto, is at roughly 10 to 15% negative margin, still pursuing aggressive growth through losses. Swiggy's strategy, it appears, is to grow slowly but move up market. Consider Noise, its clean label private brand. Unlike other private label brands, Noise is going premium, which is high protein eggs, low preservative bread, tri-ply cookware. This isn't for easier profitability. As Sriharsha put it, Noise is not a margin maximizing equation. Its job is to differentiate Instamart and make it sticky. To the company, this marks as an attempt at discipline instead of trying to buy growth. On paper, Eternal's posture is the same, but what it means by discipline is very different. Unlike Swiggy, it's trying to scale rapidly but without sacrificing profitability. It believes it can add hundreds of stores and still be conservative. Swiggy's additions, meanwhile, are in single digits. The third lane, that of Zepto, will soon become publicly accountable as well. The company has just received in-principle approval to file for an IPO. When it's finally through, all 3 of the India's major quick commerce players will have their information out in the public for anyone to see. There's another curious development in quick commerce. Companies no longer think they have to stick to the deliveries to find profitability. Instead, they're turning to advertising within their apps, or what the industry calls retail media. Retail media can look like many things: sponsored search results, brand-specific banners you see on the app, or the little gift boxes you occasionally get with samplers from different companies. It's a sensible bargain for a brand. If you're on a quick commerce app, you already want to spend your money. This just nudges you towards a particular brand's product. This is why retail media is exploding. India is projected to spend 6,000 crore on quick commerce ads this year, a number that's growing roughly at 22% a year. This has become a massive profit lever for quick commerce firms, where the economics of delivery itself is horrible with poor margins and high delivery fees. Advertising revenue is practically pure upside. This is especially lucrative today because of artificial intelligence, which allows one to target ads almost perfectly to a consumer. Eternal, for instance, claimed that it simply didn't know if there was a limit to how much ad revenues would eventually add to its revenues. Most of that money comes from brands that are already listed on the platform. That is, when someone advertises through a quick commerce platform, it gets paid twice. First for the ad, and then second for the delivery. This adds a new dimension to why premiumization could be an interesting model to pursue in this industry. If you can focus exclusively on high-value customers, your reach as a delivery platform might suffer. But as an ad platform, you're actually better off. Now, a year ago, both Swiggy and Eternal looked like mirror images of each other. Both were food delivery giants burning capital on an unending dark store rollouts. Both were extending in roughly the same way into adjacent categories. Now, they look like they're pulling away from each other. Eternal's center of gravity has moved to quick commerce, where it has more users than for food delivery. It's investing heavily in its network, opening 216 new stores in a quarter, and that bet seems to have paid off. After all, it just printed its first profit. Swiggy, meanwhile, remains a food delivery company first and foremost. But it's making interesting choices with quick commerce, slowing down and betting on differentiation rather than trying to take Blinkit on by the horns. Which approach wins the long term? That's what we'll be looking at in the coming quarters. And now on to the next story. Since the second quarter of FY26, we began splitting up our coverage of India's IT quarterly results into largest companies and the mid-cap ones. After all, while being in the same industry, the performance of both sets of companies couldn't be more different, as India's mid-cap IT firms were outrunning their larger rivals by a mile. The thesis was that smaller, nimbler companies could use AI to win transformation work that large firms like TCS and Infosys, which have far more organizational drag, couldn't move quickly enough to capture. The Q3 FY26 results confirmed it, and so did Q4, where the AI play becomes much more visible. In today's story, we'll be looking at three mid-cap companies, that's Persistent Systems, Coforge, and KPIT Tech, and what they're saying about their year. Before we get into the structural forces at play, let's break down the numbers. Persistent closed FY26 with 14,800 crores in annual revenue, growing by 17.4% year-on-year. It delivered 4,056 crores in Q4 alone, which was 16% higher than Q4 FY25. This is its 24th consecutive quarter of sequential growth. EBIT margins hit 16.3% in the quarter, while the full year EBIT margin settled at 15.6%. Meanwhile, Coforge's Q4 revenue came in at around 4,450 crores, up 21% year-on-year. Its total revenue for the year was 16,400 crores, which was 29% higher than the previous year. Its EBIT margin reached 16.6% in Q4, which was the highest ever quarterly margin. Their profit after tax this quarter has more than doubled. KPIT, which is the automotive-focused IT services firm, reported 1,700 crores in Q4 revenue, its best quarter by revenue, up 12% year-on-year. Its EBITDA margins were maintained at 20.6%. However, the full year picture was actually softer because total FY26 revenue grew only by around 5% year-on-year at 6,455 crores. Its net profit also fell by 33%, but not because of operational problems. Rather, it was because of currency depreciation and loss of non-core sources of income. In our recent podcast on Subtext with veteran IT professional Ameya, we dove deep into why domain specialization is one of the likeliest moats as AI looks to disrupt the industry. He called it the answer to all the ways in which AI looks to flatten the old business model of Indian IT. This quarter, we could see that exact sentiment made far more explicit by Coforge, which said that they see 6 moats in the AI age. In order of importance, they are domain specialization, client relationships, human AI agent flexibility, agility at scale, a scalable AI platform, and AI-enabled workforce. Domain depth is the anchor around which all other moats circle though. The reasoning is simple. Generic AI skills applicable across the board are easily commoditized, but understanding how to use LLMs with enterprise context provides a massive leg up in the driving business outcomes. For instance, 26% of Persistent's revenue are made from healthcare. In its earnings call, it discussed how it streamlined early drug discovery for a pharma client. It helped the client streamline data from its siloed datasets, create a knowledge graph out of it, and then trained OpenAI's GPT models on that structured data. Now, how does this help? Well, drug discovery is very uncertain business because human biology is extraordinarily complex. A molecule that appears promising in early research often fails later in clinical trials. Researchers must navigate massive amounts of fragmented data while trying to identify which biological pathway are most likely to lead to successful drugs. That's where someone like Persistent comes into the picture. It ensures that the client has a second brain that they can easily tap into data and query an LLM on that data to find various possible answers to one question. And with this, Persistent is also building a repeatable solution that they can convert into their own proprietary AI platform. That's how, for instance, Persistence has embedded its SASWA platform across the software development lifecycle. Such a platform is often trained on the specific process logic of those industries, and with each client iteration, the product itself is improved. A generic coding copilot without this context in comparison may struggle to do the same. Similarly, KPIT has an IP called Beacon, which acts as an AI harness. In their view, while AI dramatically accelerates code generation, producing 10 times more software means encountering 10 times more integration bottlenecks. Moreover, unlike many of its peers, KPIT's work focuses on building software solutions for complex hardware, which is a whole another ballgame. Beacon is designed exactly to resolve defects in the complex digital cockpits that a generic model would find much harder to navigate. As we'd highlighted in our large cap result story earlier, physical AI is an emerging opportunity that certain players are far better poised to take advantage of than others, and KPIT is one of them. Coforge, meanwhile, is the industry leader in travel IT services. It has a product called Decisioning Atlas, which is a knowledge graph layer that enforces domain-specific reasoning chains. This prevents a generic LLM from hallucinating by providing the rules and constraints within which, say, an airport operator or airline operates. This proprietary grounding in specific industry workflows is what separates applied AI from horizontal AI skills, which commoditizes far more quickly. Naturally, designing such applied AI solutions requires strong client relationships and an ability to move fast when things changes. We all know by now that AI will render pricing as per headcount and manpower more irrelevant, as clients will demand more transparent and outcome-based pricing. In our coverage of the Q4 results of large cap Indian IT, we took a look at where companies are in this transition. Midcap companies, however, are progressing far faster in that aspect. Take, for instance, KPIT. Over 80% of its new contracts are now fixed price and outcome-based, with the management actively converting the existing book towards a similar structure. In fact, in FY26, 65% of KPIT's total revenue came from fixed price contracts, up from 57% in FY25, which is a very meaningful move in a single year. Meanwhile, Coforge is executing this transition through what they call mod squads. The model replaces traditional T&M billing with a fixed monthly subscription for a pre-built AI agent teams where clients pay for a result rather than hours. For instance, their insurance underwriting squad has cut underwriting cycles by 50% for one client. However, the million-dollar question that arises from this is, isn't AI deflating your business in the short term? For one, it shrinks your old revenue. But secondly, with new technology, clients demand lower prices for the same outcome. And third, as companies compete heavily for the same contracts, prices only go down further, passing productivity benefits back to the clients. Well, if the results of these companies are to be seen, that's not the belief they hold. Coforge CEO's position on AI deflation is explicit. While AI-generated code is cheap to build, it is expensive to own, secure, and maintain. For players that combine domain depth with technical capability, which he argued since Q2 FY26, agentic AI creates a massive recurring managed services layer that didn't exist before. Persistent CEO made the same argument from a different angle. He expects his firm to deliver faster outcomes through its proprietary AI platforms. That speed, he believes, will help him retain some margin improvement rather than pricing it away entirely. This perhaps is why when analysts pressed Kalra whether AI productivity gains get passed back to clients, he bluntly said that Persistent will not engage in a race to the bottom by passing 100% of its platform-driven cost savings back to the clients. That's the exact opposite of the narrative in the large cap IT. For instance, Infosys did admit that they were pressured to pass on benefits to clients in order to win the market share. There's another important signal where the pricing shift is visible in the headcount numbers. Take Coforge's example here. Between Q4 FY26 and Q4 FY25, its revenue in rupee terms grew by 30%, while its employee costs grew only by 20%. Much of the gap between the two line is likely AI doing the work that previously have required additional hires. Yet, even with strong numbers, the headwinds are real enough that none of these management team is fully ignoring them. And we highlighted many of these risks in our first primer on the subsector. For one, diversification or the lack of it remains a structural risk for Persistent and KPIT. Persistent's top 10 clients account for more than 42% of its revenue, and nearly 40% of its revenue come from just one category, the high-tech industry. KPIT even admitted that while their strategy is meant to focus on their top 25 clients, most of their growth was driven by just 8 automakers. In fact, their strategic clients drive around 85% of all their revenue. By virtue of their unique business, KPIT's situation is perhaps more acute. Two of its largest software-defined vehicle programs are winding down by next year. If those programs had continued, KPIT would have seen an additional 4 to 5% sequential growth per quarter. However, they're optimistic that they can eventually offset this with new deals. But the real issue is much broader. Across the world, the automotive industry is seeing a down cycle. In particular, European automakers, which make up a large chunk of KPIT's business, are struggling. This, as we'd covered 2 quarters ago, is what also ailed Tata Elxsi, a more direct peer of KPIT than Coforge or Persistent. Beyond this, though, geopolitics has created a strange dark cloud over the heads of the industry as a whole. For instance, Coforge suffered a loss of 140 to 150 crores on hedges as the rupee depreciated against the dollar. Additionally, due to Strait of Hormuz crisis spiking oil prices, global airline Spirit Airlines had to wind down their operations. This directly hurt Coforge's margins, but the hit didn't make a material difference to their otherwise solid quarter. And since most of the cars still run on oil, KPIT also finds itself in the crosshair of this crisis. They haven't seen higher oil prices affect the spending of their clients yet, but are certainly worried if situation persists over the next few months. What's also worth noting is that by KPIT's own admission, their growth is not dependent on EVs. The midcap IT business is riding tailwinds that are far more favorable than their larger peers. The strongest defense is their proprietary IP built on domain depth, which they combine with their lack of organizational bloat and ability to move fast. But here's the thing, as enterprise clients build more in-house AI capability, with each new LLM development, clients' patience for premium-based domain expertise could actually compress. There is a little visibility on definitive AI mode. For KPIT in particular, the priority is more immediate, as they also try to navigate headwinds in the sector that's struggling globally. But largely, their answer to AI deflation has been what any company can and should do in the face of new technology. Invest in innovation, then commercialize the innovation as quickly as possible. And now onto the tidbits for the day. During its recent earning call, Hyundai Motor India plans to spend 7,500 crores in capital expenditure and will roll out a new mid-size SUV and a localized electronic compact SUV this year. Hyundai expects its domestic sales and exports to grow by 8 to 10% in FY27. Next up, the Indian rupee endured its sharpest drop in more than a month on Monday to end at its weakest closing level on record as a run-up in crude prices battered the currency after US. President Donald Trump rejected Iran's response to a US peace proposal. And finally, the Securities and Exchange Board of India, SEBI, has proposed additional measures to its earlier proposal of reintroducing open market buybacks through stock exchanges after consultation with the Primary Market Advisory Committee. And that's it for today. We'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.